This credit card news is terrible for millions of new LLCs across the country because this year banks are tightening up their purse strings and lending less. Startups and new businesses don't have the established credit history that older businesses do, making it harder for them to meet these stricter lending criteria that banks are asking for. This means you're going to face more rejections, and if you do get approved, it's going to cost you more and eat into profits. It's just overall a tougher climate to be looking for business credit, especially if you're just starting out. Banks are preparing for potential economic downturns, which makes them less willing to take risk on new LLCs. I even spoke with the VP of Business Development at a major business funding broker that handles hundreds of deals each month, and he confirmed that banks are definitely tightening up.
Yeah, especially these days, Cal. A lot of banks have stopped commercial lending or paused you being able to access lines of credit. They've even called in those lines of credit if you're in some of these high restricted industries.
And before I forget, I just created a no PG business card master list. It's got over 25 cards on there and counting. So your high credit usage will never affect your personal credit report. It just doesn't show up there at all. There's absolutely no hard credit pulls whatsoever, and your credit score stays untouched. And here's a big one. If your business ever struggles and you have to shut it down for some reason, you pretty much can walk away debt-free because you're not personally on the hook for repaying the money. It's your business. And to get instant access to the No PG Business Card Master List, just hit that link below. Now, moving on, I had no idea there were this many reasons for banks to pull back on lending to small business owners. First is high interest rates. One of the biggest factors here is the Federal Reserve hiking interest rates. Even though they recently lowered it a bit, they've still been high for a good amount of time. And they were raising rates in the past to fight inflation, but it has a downside. Higher interest rates mean borrowing money costs more. And according to WalletHub, the average interest rate for business credit cards is 22.16%, and that's up from 20.5% at the end of 2022. This rise is a direct result of the Federal Reserve's rate hikes aimed at controlling inflation. For new LLCs, these higher rates mean that borrowing costs have increased substantially, making it more expensive to finance their operations and growth through credit cards. Then there's the economic uncertainty we're all feeling.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
With high-profile bank failures like Silicon Valley Bank shaking confidence, banks are really getting more cautious. This caution translates into tighter lending practices because banks don't want to risk lending to businesses that might not be able to pay them back. Now, Capital One, along with other major banks like Chase and Wells Fargo, have reported increases in credit card delinquencies. This rise in delinquencies has prompted banks to tighten up their lending practices even further. The uncertainty around consumer spending and the broader economic outlook has made banks more selective about extending credit. And that directly affects new LLCs that rely on business credit cards to manage cash flow and finance growth. For new LLCs, this means jumping through more hoops to secure financing as banks really scrutinize applications more closely. And in the realm of regulatory and legislative challenges, efforts to enforce transparency in lending has had mixed outcomes. For instance, California has made progress by passing laws that mandate APR disclosures and ban junk fees. Also, beyond California, other states like Connecticut and Illinois have also taken significant steps to increase transparency in lending and eliminate those junk fees as well. Similarly, Illinois is considering the Junk Fee Ban Act, which mirrors California's legislation to prohibit hidden fees. Now, these state-level actions create a complex regulatory landscape for new LLCs as banks really adjust their lending practices to comply with various regional laws. And let's dive into some numbers and insights to paint a clear picture of what's happening with credit cards for new LLCs. The Federal Reserve Senior Loan Officer Opinion Survey is a real goldmine for understanding current lending conditions. And recently, the survey revealed some eye-opening trends. The survey found that banks are increasingly tightening their lending standards. Specifically, 21% of banks have made it harder for small businesses to get loans. And this tightening is most pronounced in smaller and mid-sized banks, which are often the go-to for new LLCs. And a notable portion of banks reported stricter criteria for loan approvals, which is significant because these banks traditionally serve smaller businesses. And according to payments.com, less than half of the firms with up to $10 million in annual revenue reported having access to business or personal financing. Now, the scarcity of available credit is a significant hurdle for new LLCs trying to really establish themselves and grow. And according to another survey by Goldman Sachs, 86% of Black small business owners surveyed are concerned about access to capital, which is higher than the overall percentage of 77% of small business owners. These statistics and insights highlight the increasingly tough landscape for new LLCs when it comes to securing credit. The tightening standards and cautious lending practices really underscore the need for new business owners to explore all their options. I found some specific real-world examples of how banks are making it tougher to get business credit. There's just higher credit score requirements overall. Banks are raising the minimum credit score required for loan approval. For instance, after 2020, many lenders increased their credit score cutoffs by about 20 to 40 points. A small business owner with a credit score of 680 might have qualified for a loan pre-pandemic, but now that same requirement might be 720 or even higher. I've seen Amex's business line of credit score requirements jump from 600 to 620, and now they're up to 660. And then there's been increased documentation. Lenders are demanding more detailed financial documents, where previously basic financial statements might be okay. Now, banks may require several years of audited financials, tax returns, detailed cash flow projections, and even more comprehensive business plans. Then you have the stronger collateral requirements. Banks are more insistent on having that collateral to back up the loan. A loan that might have required general business assets as collateral now might demand more specific and valuable collateral, such as real estate or personal assets of the business owner themselves. Plus, there's been reduced loan amounts. Even for approved applications, the amount of credit extended is often lower than requested. Banks are capping loans at amounts lower than what businesses need or have requested based on more conservative risk assessments. And I can't forget about the worsening borrowing terms. There's higher interest rates, which we spoke about before. The borrowing costs have risen significantly. Business credit cards, for example, have seen average interest rates climb above 23% compared to lower rates in previous years. This increase directly impacts the cost of borrowing for new LLCs and other small businesses. Then there's shorter repayment terms. Lenders are offering shorter repayment periods to reduce their risk exposure. Loans that previously had a 10-year term may now come with a 5-year term, increasing the monthly repayment burden on businesses. Plus, additional fees have become even more common. Origination fees, service fees, and higher late payment penalties are now frequently attached to business loans. All of these added costs make borrowing more expensive and really challenging to make new LLCs. And we're even seeing more loans that now often come with more restrictive covenants. And those are conditions you must meet as a borrower. These might include maintaining certain financial ratios, limiting additional borrowing, and frequent reporting requirements. If you don't stick to these covenants, you could face penalties or even have your loan recalled. But you know what I found? There's a few things that new LLCs can do to kind of beat this. If you take the next few steps, then you can dramatically increase your chances of getting funding. Even as a new business owner, one of the first steps is to open a business checking account with the bank where you plan to apply for a loan with. Then regularly deposit significant amounts of money. I'm talking $1,000 to $10,000 over at least 90 days. This activity not only increases your bank rating, but also shows the bank that your business is financially active and stable. Consistent deposits really help build a positive transaction history, which can be crucial during the loan assessment process. Then after you set up that account, you want to use the other banking products with that same bank. And that's going to help you further strengthen your relationship with them. You want to use a variety of the bank's business banking products. This could include savings accounts, business credit cards, merchant services, or even payroll services. Really engaging and using multiple products demonstrates your commitment to the bank and can often result in more personalized and favorable terms. For example, Chase recently pre-approved me for an Ink Business Cash Card with a 100% guarantee of approval before I even applied. They flat out said it was because of my past relationship with them and my use of their other personal cards and business cards. I have the Freedom Unlimited card and the Ink Unlimited card. So once I saw that pre-approval, I then applied and got approved for a $13,000 starting limit. Another thing you can do is visit your local bank branch. A face-to-face interaction is really invaluable. You want to make a habit of visiting your local community bank or credit union branch regularly to get to know the business bankers personally. These bankers often play a key role in the loan approval process. Building a personal rapport can provide insights into the bank's lending criteria and allow you to really customize and tailor that application accordingly. And those friendly and professional relationships can sometimes tip the scales in your favor when your loan application is being reviewed. And another thing a lot of you could do, I know you may not want to do this, but it's going to put you ahead of all the rest of the small business owners, is preparing detailed financial documents. Having really detailed and accurate financial documentation is crucial for improving your chances of securing the loans. I'm talking profit and loss statements. These documents show your business's revenues, the costs and expenses over a specific period, and that's going to provide insights into your profitability and your operational efficiency. You also have cash flow statements. These statements detail the cash inflows and outflows from your business operations, plus those investments that you're making in the business and financing activities. And a lot of lenders now are asking for audited financials. Having several years of audited financials can significantly strengthen your application. These really provide an independent verification of your business's financial health, making your application more credible and trustworthy. Now, if traditional bank funding is hard to come by, there are other routes that you can take. You got online lenders and brokers, and fintech companies are both great alternatives. These lenders have more flexible lending criteria, faster approval processes, and higher limits too. One card I got approved for, and a lot of you can actually access as well, is the Bill Divvy card. There's no hard credit pull whatsoever to get approved. You got no personal guarantee. You get up to 7x points on dining spending. It never reports to the personal credit bureaus and only reports to the Small Business Financial Exchange. They also approved my business for a $2,000 starting limit about a year ago when my revenue was much lower. Then there's the Ramp card. There's no personal credit check to get approved. There's no personal guarantee as well. They advertise that you can get 20x, so 20 times higher credit limits with them than traditional banks, up to $2 million. They report your usage to the Small Business Financial Exchange as well. Plus, for the first time ever, you can now get your business funded by working with me one-on-one. I'll help you secure $50,000+ in business funding in just 30 days without any guesswork. We'll use my proven 3-step strategy customized for your business and done for you. I'll set you up with a list of banks most likely to approve you. I'll create a personalized funding strategy that's going to be tailor-made for your business. Plus, you'll receive live guidance during the application process. So if you want to eliminate the guesswork you've been doing and work with me one-on-one, then just click the link below to fill out an application. I'll get back to you within 48 hours to let you know if you're a good fit for the program. Now, I know that was a lot of info, but if you're just interested in a card that you can get approved for without a hard credit pull, then check out the next video where I show you 8 business cards that do just that. Plus, you'll see how I got my business approved for over $16,000 in business credit by using those same options. Thank you for watching.